thanks, Jeff, for inviting me. And I guess when you talked to me about this the first time, I think we both at the Utah Winter Conference desperate to get on the slope. So yeah, thanks for remembering.
And there might have been beer involved too.
There might have been beer involved, yeah. So great, great stuff. Yeah, this is definitely an opportunity, a fun opportunity to kind of pass along some of my very biased views and kind of experiences and things like Alex pointed out, things that maybe people should listen to, or listening to referees, integrating what the overall legal profession thinks, and some things that were scratching under my nails when I listened to the other talks come maybe up again or implicitly on the slides. So I hope you can, things are interesting for you. Just ask me a question or interrupt me, and we can maybe have a two-way conversation as opposed to me going through the slides. But here are the three things, or the convex combination of what Jeff wanted to see, because he sent out an email as well for all of you who still read email, with what he thought would be useful to have here. So path to success in the profession. Well, I mean, just outline of what I'm going to talk about. It is sort of always easier to say that it was easier in the 1970s, and having heard about Black Scholes just a minute ago, this paper did get rejected a couple of times before it went into the JPE. Can't believe it, but it's true. And why did Merton's...
Because Merton called it, right?
And why did Merton's model end up in the Bell Journal of Economics as opposed to in, Econometrica? So, and on my dissertation committee, we had George Akerlof, the Lemons paper, and you can't believe, I was at Berkeley when he was awarded the Nobel Prize. His first part of the speech was, one of the most foundational papers we have in pre-behavioral economics, now in asymmetric information economics, was rejected 5 or 6 times. This is what he started out saying with, having gotten the phone call from Stockholm in the morning, and referees had, 40 years ago or so, giving him all the heat they could, because this was a non-standard assumption to make, that there are two types, a good and a bad type. Jeff the good type, Dirk the bad type. Obviously that's true, right? But in the like you said, to put the paper into perspective, it was just impossible, inconceivable to make this assumption. So he, had to fight. So one of the messages, I guess, is to be creative and to work hard, given that, personally, my opinion is things have gotten even harder. Of course, in the position to say, tenure job, everything, some papers, I guess not as many as Mike or Peter, but some papers under my belt and some recognition. But working hard, or I think he pointed this out as well, is just like a minimum requirement. And then being creative and hoping to find some important questions and then stick to them. And just to say, George Akerlof got rejected 6 times. Who am I? I'm going to go for this. Let's say 5. I don't remember this. 5 times? Well, maybe he published that speech, and we can track it's a long time ago, but he did say 4 or 5. I think 5 or 6 was the number, and then he referenced the other. Okay, so then before I read the email, so a few days before the conference, I actually read Jeff's email about what I was supposed to talk about. I was only going to talk about my papers, because that's what academics care about. I care about beers, I care about having fun, but actually, I used to have all kinds of sports and hobbies and things, and I cut it down to bicycling, but I used to do all kinds of other things, and when you become an academic on tenure track, you just focus on only caring about one thing. So Jeff suggested we should bring some thoughts about how the profession might evolve, and I'm of course a much more junior, sort of senior person than Peter and Mike, so I'm much more wedded to the little things I care about, and I'm going to tell you, lay out a little bit what my research has been about, how I built my research agenda, and where I think this tiny little thing of the world that almost nobody, maybe a dozen people in the world really care about, and everybody else says, well, what are these people doing? Structural, whatever, dynamic corporate finance, boring. So, but I care about this, and I'm going to try to give some suggestions where the literature is right now and how we could move this literature forward and advance our understanding of corporate finance and complement other people in corporate finance. And then the last, so this is literally copied from, well, not the first one, but the structure from Jeff's email. Third point, more general advice, and we've seen a lot of general advice here, and maybe some will be complementing. Well, jumping to the most subtle point in there would be It'll help if you promote yourself, but over-promoting yourself can also hurt. So it's going to be really tricky to go to these cocktail receptions and ask people what they think. If you have a good question, great. But to push your papers too much can also backfire. Not that I have experienced this, but I've seen people maybe, so it's a subtle path, and we'll maybe hopefully get there if I have enough time. So first point on this outline will be fairly quick, given the other things we've seen. It's not really easy to define how to be successful, and it's, once you see someone is successful, great, then, stop doing everything else you've been doing, it's maybe fine, but every case is different, so I think it goes back to hard work and creativity and really sticking to your personal skills. The research that you do is a reflection of what you can do and what you're interested in and what you're willing to spend 12 hours a day for many years every day. So you really need to be committed to it. Then in terms of more breaking it down into actual implementable plan, which is what some of my colleagues, assistant professors at BU, still don't fully internalize. Sending you out your papers fairly quickly at the beginning of the tenure track might actually give you a chance to get published at the beginning of the tenure track. If you don't send out your papers, and don't ask me how many times I may have said this over lunch, if you don't send out your papers, you for sure will not get published. If you send out your papers, you might get rejected, and that hurts, and they might think, like they thought about George Akerlof, you're kind of doing the wrong thing, but you can undust yourself and figure out maybe what was constructive in the criticism and move on and try to get. So I was fortunate to have some senior co-authors in the beginning, Leland and Hennessy, and so that paper, of course, was rejected a couple of times. Once with one paragraph rejection, which is kind of obnoxious, but that happens as well to Leland. So just try to get published as soon as you can, and then already with your dissertation, I hope you would have had some coherence and some kind of connection in your research, and try to think about how, even if there's no connection yet, how you could build a connection so that there's some ability of the profession to think, well, this person stands for boards, this person stands for private equity, for behavioral neuroscience, etc. So people are also humans. They want to have a bridge or a link, a mental link for you to be associated with this. So that would be good. Somehow I kind of happened to run into those people, but then when I was an assistant professor, I didn't really plan this. I ran into other assistant professors who were hardworking. Not a bad idea, right? Instead of working these single-authored papers that are really boring and difficult, but you have to be a little bit lucky, and given you're here now, we're spending time about finding highly motivated co-authors can actually help. Going to conferences is obvious one. Not so obvious is do your reports on time and try to write good reports. Editors are actually paying attention to what you do on the other side as well. There are rating systems for some journals. So you might increase your reputation as well here, and then hopefully get associated with one kind of field, and I'm just going to put this up here a couple of times because there are not that many of us who believe in this field, so dynamic corporate finance might be one of them. So this is my research style here, or my kind of research strategy. We are in applied social science, be it economics or finance. We need to have an interaction between theoretical understanding of the world and empirical understanding of the world. So without this communication or dialogue, it's going to be very difficult to really completely understand what the empirical results mean. And also, like in the financial crisis, for example, there were some big judgment calls, big decisions to be made that couldn't be made based on, given that there was no data or no empirical evidence. So sometimes the model can actually become relevant before the data if you believe in a certain banking model, a certain regulation model. So it's not clear that one precedes the other. Secondly, discipline, guidance, and rigor and structure are provided by a model that forces you to tie down your hands in terms of a few important assumptions. And then you'll find that oftentimes economic intuition can be reversed. So there can be a counterintuition or counterintuitive result that you wouldn't have found without saying, okay, I make these 5 idiotic assumptions, whoever. I mean, every assumption can be criticized, but putting them together and saying some of them come from prior work, some of them come from me, might then move us forward in this profession. And this is here now where I really believe research and finance has been evolving, and we're not just a pure theoretical field where we can write down something in Hilbert space. We want to gain insights from studying new data sets, or study new questions in older data sets. So I'm saying all that regressions are fine if there are new questions. I definitely believe in mean reversion. We're overdoing what Alex is doing, but that's just my view. So moreover, you can have models nowadays where the kind of limited set of assumptions, which are good or bad, and can be replaced by better assumptions if you want to move this field forward, can produce simulated data sets, so that you run these regressions that everybody runs, even if they're just or less regressions and they're subject to all kinds of criticism. You can run them on simulated data sets and see what would happen to the data if actually your model firms produce the data, and then tweak around how the model firms behave and learn something about where correlation can, given that it's a model, is kind of causation is hardwired into the model by definition, and therefore the correlation coefficient will tell you something, at least for one version, and you clearly there are always alternative versions to potentially suggest, especially if you're discussing at a conference. Now, I still believe this is a step forward, because then with a similarly rigorous process, you would have to produce a counterexample for the other alternative interpretation of a similar regression coefficient. So here are my 2 or 3 slides on what I think the dynamic corporate finance models stand for, and why they actually have been so successful. Going back again to Black-Scholes and Merton, the contingent claims approach to valuation provides a standard kind of routine, a mechanism for pricing risky claims, for pricing claims, corporate claims under uncertainty. So we get a fairly elegant, a fairly realistic, given that asset pricing people care about this all the time, fairly realistic valuation toolbox from the asset pricing focus. Now, why are values really important? Well, if you go to practitioner conferences, if you talk to managers, if you just teach an MBA class, we all value maximize. Hey, but where's the value, right? So dynamic corporate finance actually gives you a thorough valuation toolbox, and then you can, based on the valuation, you can derive value maximizing, maybe equity value, maybe return value maximizing decisions, such as bankruptcy, investment, acquisitions, and so on. And on top of this, you will, with this kind of framework, because you have to stick in parameter values for the valuation to be used, you get more precise quantitative guidance that potentially can be criticized also more readily, but you're sort of raising the bar and say, well, I have a model, great, but I have a model maybe that can also quantitatively match the regression coefficient that Mike found in some paper. And then we say, well, this model is really close to what Mike was doing, but it actually reveals also the underlying mechanism causation that leads to the quantitative, to the economic magnitude of Mike's regression coefficient. And then sometimes, not always, some solutions can be a bit of a mess, depending on how much algebra you can endure. Then the solutions are not as transparent, but we do believe we get also fairly, we get some transparency or some information simply by getting closed form solutions. They're not means to a result, to an end on their own, but they help understanding where the economic forces are, in contrast to some other discrete time multi-period models, which often have a lot of kind of constraints and boundaries, and you have sort of kinks, and there's very, very little you can do once you solve out all the kinks. So I should probably say some of these thoughts are pretty heavily borrowing, relying on the editorial piece we did for a special issue in the Journal of Corporate Finance recently with Itai Goldstein. So here we kind of pointed out that not only one unique aspect of dynamic corporate finance models is this potential for using quantitative guidance, but also the fact that we can simulate the model and then go even one step further, go through a loop of optimizing the model such that certain parameters generate certain moments that match the moments, the empirical moments we see in the data, which is called simulated method of moments or structural estimation. So that again, we can with the first point, with the first unique aspect, we can say something about economic magnitudes. Can the dynamic capital structure model that I write down and solve and simulate produce a realistic distribution in terms of deciles, quintiles, whatever you want to call it, mean and median, of average ratios of encompass that? Yes, they can. Investment intensities, yes, they can, and that says something about the quality of this research. And secondly, empirical regularities or puzzles. Either way you want to go. The low leverage puzzle hasn't come up, although we have all these corporate finance people here. So can we say something about why leverage ratios are so low? Yes, we can. We can make this even in a regression coefficient way. We can say something about why, I just finished a paper on that, why the regression coefficient when you run leverage on Q is negative. Has nothing to do with a negative debt capacity of growth options. Nothing. But people still think, if you read the literature and if you go through empirical corporate finance courses, yeah, debt capacity of growth options is negative. May, partially, but potentially not at all. So we can say things about correlations as well, covariances. So overall, this might be complementing other research in corporate finance or even become one of the state-of-the-art kind of approaches to research going forward with the growth path, if you follow the literature of the last 10 years, that is been relatively steep. You can always, it's sort of hard to benchmark, but for theoretical work, this has certainly been enormously prolific as an area and also remarkably successful in terms of where new results have emerged. So for example, going back to say Dixon and Pindyck, McDonald and Siegel, 80s, we just looked at investment decisions, and then Liedem came around, and maybe there were some others, predecessors, actually Fischer, Heinkel, Zecknitz, and some other guys, McDonald as well himself in the 80s. Looked at financing decisions in separation, but then only more recently people have jointly looked at all these corporate decisions and value maximized, after valuing things, value maximized these decisions, and have come up with lots of interesting results. The Rao and Sufi paper was mentioned here, and we have this paper in the RFS, Dave Maurer and I, 2012, show why it is possibly the case that Rao and Sufi find this spreading of into different price spreading of debt priority is associated with lower rated firms, whereas higher rated firms tend to concentrate all their priority in a single class of debt. I mean, they don't really have to issue multiple classes of debt because it's not optimal for them to facilitate the investment process. They don't need to do this. So these interactions of more complex financing and investment decisions are very fruitful. And if I don't run out of time, then how much do you have?
Let's call it 10.
10. Then I may get there. So then there's one slide that kind of gives directions for where we should go, and if I convince at least one person in the room after this talk, then I have already a home run. So email me, this one person, email me, and we continue the conversation offline or online, or you'll see offline at a reception, or then back online if you want to do more about this. So things have then kind of moved on into banking. Financial crisis came around, and old-style banking people like Professor Pinocchi at Illinois started writing down structural models on banking. Contracting, too many to mention. M&A is a little bit of myself, shameless plug, but others certainly as well. So things have really moved a lot. And then the part where I'm most excited about, myself, because nobody else would be excited about me. So we're doing a full circle. We go back to the asset pricing guys and say, look, we can take our option pricing models, and we can take a derivative, and we learn that the delta, the hedge ratio in the differential equation for Black-Scholes actually is what affects in the end the risk. And we can say, what are the risk implications? What are the expected returns, risk implications from these large corporate decisions? So that then these kind of corporate finance models that we kind of built on contingent claims variation can be fed back into what stock returns should look like, or what second moments of stock returns should look like. So we just published something in the Review of Economic Studies and had a follow-up piece with our PhD student that heavily builds on this idea that investment and disinvestment option exercise decisions, or just even if they're not exercised, the presence, the moneyness, the option premium of these options affects expected returns. And as we show in this follow-up paper, also volatilities, stock return volatilities in the way that such a simple model would predict. All right, so ongoing research agenda. I'm just giving a sneak preview of what I think Jeff tried to in one sentence summarize what me in the beginning. So uncertainty is important, firm decisions are important, equilibrium implications also really, really important. So one example would be, or one of my lines of research is on corporate financing investment decisions, maybe capital structure, but then adding more decisions to this capital structure decisions, multiple debt issuance decisions, or investment and financing decisions. So here is one recent example of my work, and I'll kind of try to talk just in one slide about it, maybe violating your 20-line kind of requirement. Hey, RFS actually is a 26-line requirement per page. So the font size can be tiny, but you have to have 26 lines. I think that's what Jacqueline does. So
I didn't know that. Yeah.
So anyway, I've violated that a few times.
It is true.
Now I have a line in my LaTeX code that says, okay, do this, and then you have 26 lines.
It is true that you're not responsible for all this.
Oh, yeah. So I'm always responsible for all mistakes.
It wasn't you.
All my papers.
And we'll share that over a few beers.
So second thing, like I said, I'm working on mergers and acquisitions and firm boundaries, and this sort of maybe is emerging towards innovation, which is on my slide for future research. Because it turns out we finance people at least have a difficulty to understand where these new ideas, these new options come from, or these investment options. Third, this is the one I mentioned on the bottom of the previous slide, how we can integrate corporate finance and investments or asset pricing, and thereby kind of use all the resources or level to the fullest potential of understanding of finance, and not just that the asset pricing people dabble a little bit at their fifth factor, and then we kind of say, well, gee, why do they have 5 factors? And it turns out book to market got kicked out by the 2 new factors. And we actually have an answer for that. Investment is really important. Profitability is really important. These are real options. These are potentially factors that came about because of investment options and maybe disinvestment options. So this last point here is an illustration of a major reform, and I think since you're looking out for ideas, we just thought corporate finance, debt and equity values are affected by bargaining, and if a major reform shifts bargaining power from, say, debt holders to shareholders, that should show up in prices. So maybe one of the first papers at all to show that the investment side, the investor side, is reflecting in its expectations the way bargaining power is allocated, say, in financial distress. So first paper here, financing investment interactions have been studied before, but what has not really been done by then was to look at also multiple debt classes in a coherent model. So you need to value, again, you need to have this Black-Scholes kind of or contingent interrogation approach to figure out what the right value should be. And then you can say, what is the value maximizing allocation of, say, debt seniority, debt priority? How much of the recovery value do you assign to the first debt issue versus the second debt issue? And practitioners have looked a lot at me-first covenants for the initial issue. Then there's sometimes debtor in possession financing in distress, me-first financing for the additional debt. And how to figure out all this? Well, we just said in the beginning, just ignore all this realistic sort of covenant structure business. Let's use this as a new parameter. So we have some initial debt coupon, additional debt coupon, and then the next parameter would be, what would be the optimal amount, some fraction of recoveries to give the old guys and the new guys. And it turns out there's just this little third degree of freedom, a third endogenous choice variable. After valuing everything, you can completely remove the friction that exists between initial debt holders, equity holders, and additional debt holders. So agency conflicts kind of get minimized because the dynamically optimal contract that you can commit to, of course, the question is if you can commit to it or not, will completely balance away these distortions. And then looking at more realistic covenants, like I said, the first covenants, or say pari passu covenants, equal priority, we study what happens there as well, and how close they come to the idealized optimal one. So the pari passu one actually does really well, or me first even better, depending on the amount of the growth options. So how important was it to retain financial flexibility, which means retaining priority or potential assignment of recoveries to new debt holders made one or the other covenant more important. And we especially then were happy that we could relate to this earlier RFS paper by Rao and Sufi that basically found a fairly highly concentrated debt structure for highly rated firms, and then the lower the rating was, the higher the cost of debt was, and therefore the lower the financing, the external financing capacity was of these firms, the more important it was to retain recoveries for the future. And that led to a spreading of multiple debt issues, and also more priority assigned to later classes. And then we could also relate to financial constraint results that were in their paper, but the main one is maybe the last bullet point. And as Mike already pointed out, with the hybrid securities that we see emerge everywhere around the world, an interaction, I still have, never have time, but an interaction between debt structure and also ownership structure, equity ownership structure and debt structure would be really interesting to understand. And I'm sure there's some factors here and there from the empirical literature, but there's virtually nothing going forward. So this is an exciting kind of, I'll come back to this. Next one is linking organizational design to product market characteristics. So we try to answer the question whether new ideas, wherever they came from, which is still the open question as well, they were exogenously given, whether new ideas should be implemented by a large incumbent firm, so 3M or something, Kodak, or by a separate small firm that we never heard of. So what are the forces, what are the trade-offs that you face there? And a real option model for the new ideas seemed to be suitable, or at least that's the one we knew how to solve anyway. And we then looked at two types of designs. One, integrated design, where the new idea would be combined under the umbrella of one company with the assets in place, and then non-integration would have two firms. It's a different design, but two firms in there. And it turns out then the integrated design protects a bit more from cannibalization effects, so there's a joint profit maximization incentive. Whereas the separated design, kind of by design of the separation, fully maximizes the option because that's all the separated small firm has, and then also provides some more financial flexibility because they can make multiple financing decisions. But what I want you to remember, and what we're still trying to put into a practitioner piece, because managers really care about these decisions, that there's a surprising contrast between cash flow risk and product market risk. So product market risk would be obsolescence or preemption risk, and that actually calls for more integration if that type of risk is high. However, if market demand uncertainty is simply high, then it might well be that the conventional wisdom is true, and you would want to separately integrate, separately configure the small firm as opposed to putting it into the large firm. And financial alliances, because they're hybrids again in the same sense as the hybrid securities, they have a little bit of both, and depending on both effects and depending on how you structure the financial alliance, we show that there's actually an optimal share, an optimal revenue sharing amount or fraction that will kind of similar to that will get the highest possible value, even more. There was no agency conflict, but even more than you could get as a sum of the pieces from the kind of one extreme endpoints of full non-integration or full integration. So the optimal thing is somewhere in between. So last paper, and then I conclude with a couple of projects. We could look at bankruptcy reform, big exogenous shock to allocation of bargaining power, turns out also really big effect on equity risk of distressed firms, in particular expected returns. So when equity holders are expected to get something in distress as opposed to nothing, absolute priority violations emerged in the early 1980s. Their expected excess returns, well, what we measure is realized returns, but the structural model predicts expected excess returns decline, and so they realized returns. We did some different type of thing as well, differential effect, no time anymore to talk about, but you're welcome to look at the paper and your questions. So where do we go? Kind of a bit of a use of language here. In German, this would be the proper use of Latin. What are the prospective topics, the corporate finance perspectives? I think these feedback effects that Itai and co-authors always work on, like our risk effects from the previous slide, how does corporate finance affect the expected return and the volatility of equity returns, is really exciting. We still, George Benaki's paper still not published for some exogenous reasons, so he's like Akerlof in a way. He started in 2010 posting it. So bank capital structure, bank policy, to put everything that a bank does, risk management of the loan portfolio, the trade-offs that the bank faces in terms of taking on more loans or less loans, becoming more or less risky, are really, really things that we don't understand well. There are a couple of papers out there. I discussed one at the AFA, great paper, but they always look at very isolated effects and then come back to something that maybe, well, let me move on. Compensation contracts have been integrated a little bit into these dynamic models. What I think is very generally kind of hard to understand is where innovation incentives or innovation kind of, characteristics are feeding in these decisions. We have some ideas, but very vague ones so far. This is just to make Mike happy again. I just did this on the fly. Debt structure, more complex securities. Yes, you're right, but it's even more complex to model it. But you might not satisfy the Occam's razor kind of criterion for it. So give a clean model, but we should talk afterwards. What do you think are the most pressing questions there? Well, keep on a fruitful dialogue, try to make models that link to empirics, and hopefully Joe the other way around as well, have empiricists kind of link their tests to models would be very useful. So this is, I think, where you make the most impact. The profession nowadays is very empirical, and you can go through the journals and count fractions, but I was happy that Peter mentioned impact. I mean, nobody can assess his or her own impact, but at least there are fewer theory papers to choose from for assigning a given amount of impact. So there might be even more impact if you have clear predictions. Last slide, advice. Well, this is again what Jeff emailed us. I think prioritizing research is important, advocating your papers. Really, I mean, there's some friends and colleagues I have who don't like to talk about their own papers and just say, well, it's okay. That's not enough. Okay is not enough. Okay is not going to get you into JF. Trying to be conservatively optimistic about your research and trying to lobby for it might be something to do, because if you don't do it, nobody else is going to do it. Maybe your advisor is very nice, but that happened to me in one case or two, but and I still officially don't know about it, so I don't know. But posting on SSRN, obviously, there's some people who don't have this, some people who don't have the website, so Bill Schwartz always used to say to his assistant professors when they come into Rochester, create a website and make yourself visible and try to show the world that you're doing something, which is also a commitment device to doing something, because once you have a website and it's not updated for 7 years, well, you do the math. Sending colleagues your paper might be helpful, and that also goes hand in hand with finding these hard-working, interesting, exciting co-authors. But anyway, never doubt your ideas. Once you sort of decide to do something, you might just go with it, and what else do you have to go with? Timely reports already mentioned. Try not to say no to editors. This happens to me sometimes with management science, which is, I think, a great journal. And some people think they're too busy, or even Journal of Banking Finance, great journal. But why say no to someone who thinks you are a good match? Is just beating me. Right? Try to get your job done. Teaching is very important. Constraint optimization, so time management. Service in your school. I think my favorite service and only service before tenure was organizing seminars. So try to tell your department chair, Dirk said that, and don't do anything else. Otherwise, your department chair can run well. Thanks for listening, and good luck.